afternoon, everybody. My name is James Bauman, and I'm an internal sales associate here at National Life Group at the home office in Montpelier, Vermont. I'd like to thank everybody for attending this afternoon's webinar presentation. Myself, as a member of the sales desk, I also want to express my gratitude to all of you guys, all the hard work you do out in the field, and it's a joy to work with all of you guys, helping train you on your product line with presentations such as this, and I greatly enjoy all the phone calls we have with all you guys out in the field. So everyone, keep up the great work. Today, what I'm going to do is help you guys out, explain a benefit that exists within our Index Universal Life product line. It's called the Lifetime Income Benefit Rider, or the LIBR, to shorten things up, make it easier. During today's presentation, I'm going to explain the LIBR benefit, how it plays out within an IUL, and I'm also going to explain how this differs from taking a regular loan out against your Index Universal Life policy. First part of this presentation, I'm going to be explaining what the LIBR benefit is. After we're done with the presentation, I'm going to jump in and show you guys an illustration, show you how to illustrate LIBR benefit, and I'm also going to show you how that compares with illustrating a policy using just regular loans, so you guys can see the difference between the two distribution methods. I promise at the end of the presentation, I will allot some time for questions, as I'm sure there will be plenty. As we go through this presentation, as always, I encourage everybody to take notes, jot down questions you have. I can satisfy those inquiries when we're done with this presentation. And aside from that, without further ado, let's get started with today's presentation, starting with the LIBR. So as we get started, remember, one of the most prominent anxieties we have, as well as what our clients share in life, that's the fear of living too long, the fear of outliving our financial resources. As you guys can see from the statistics right here, most Americans, it's projected, will spend nearly 35 years of their life in retirement. During this time, they've stopped working. The bills don't stop, though. More of us, as we grow older, we're getting more concerned about the rising healthcare costs. On top of that, to add to these fears, we know that right now, plenty of people find themselves in a situation where they have little to no savings for retirement. These all make that anxiety about outliving our financial resources much more prominent. So how are we going to address this? Guarantees are now more important than ever. So what guarantees are there? Let's think particularly about our line of business. Well, the old saying, death and taxes, those are guaranteed. Also, when it comes to financial services, what we deal in, market volatility, that's guaranteed to remain as well. Your clients, they have a need for the death benefit protection that's offered through a life insurance policy with National Life Group. They also have a need for the living benefits that are offered through our policies at National Life Group in case they become ill during their lifetime. There's one last feature of our permanent life insurance products that can be utilized to address this fear that we will live too long. That feature is utilizing the cash value in permanent life insurance policies to supplement an insured's income when they retire. And that brings us right into the LIBR, the guarantees that you'll enjoy with the Lifetime Income Benefit Rider. Number one, you'll still maintain a tax-free death benefit. Though the LIBR payouts continue to your clients and they'll stop paying premiums into the policy, they're still guaranteed to retain a death benefit that will be passed on to their beneficiaries tax-free. That death benefit will never go away, even though the LIBR payouts are coming to them and reducing the death benefit. These payouts that come via the LIBR benefit, they're guaranteed to last as long as your client is alive. They will never stop during their lifetime. As I mentioned earlier, though the payouts are coming to your clients, they're coming out of the cash value and reducing the death benefit, But we will guarantee that as this benefit is received, the policy is still going to stay in force. They'll still have a cash value and a death benefit. We guarantee them that they're not going to have to call us every single year and fill out additional paperwork to receive this benefit. All it takes is one completed form when they decide to activate the benefit. After that, the payouts are systematic and automatic. They will come to them each and every single year, those payouts will. No additional paperwork is required after the LIBR benefit is initiated. Clients want guarantees that their policy is not going to lapse. Well, guess what? LIBR provides that guarantee. As I mentioned earlier, these are loans that come against the cash value and the death benefit of the policy. They never have to be paid back. Them with a guarantee that their policy will not lapse as a result of these benefits being they're guaranteed to have to make another premium payment into the policy. This benefit, we give them them money, they don't have to give us money in return. All this, we're guaranteeing them that they can experience life and go through without worrying that their income stream will all of a sudden be cut off, as these LIBR payouts will continue to them for the rest of their life. So what is the lifetime income benefit rider exactly? Well, it's a feature of our Index Universal Life product line. It's important to remember that this benefit is not featured on whole life or universal life policies. The LIBR, it's a rider that uses fixed net cost loans and the interest credited to the cash value of the policy to produce a tax-free benefit payout to your clients. These benefit payments, they're guaranteed to come to your clients for as long as they live. Guaranteed income for life. Now let's think about clients that we have who benefit most from a benefit like this. People who want permanent coverage with a death benefit that will not end like a term policy. An Index Universal Life Insurance policy is a great fit for them if they want a permanent death benefit to protect their family. But with these people who have these permanent life insurance policies, we find that later on in life, when they get older, their obligations in life start to drop off a little bit. Think about clients you have that get into their mid-60s or so, or maybe even later or earlier. At that point in time, you start to see that kids that they were once supporting have moved on and are now not as dependent on their parents. They're not dependent at all. Also, around that age, it's not unrealistic that mortgages start to be paid off. With those obligations dropping off in life, there's less of a need for a higher death benefits. So many of these clients, they're going to look at their cash value and they're going to want to utilize this to their advantage. They're really going to want to reap the benefits from that cash value that they built up by diligently paying their premiums all through the policy history. In order for your client to maximize, the LIBR benefit when they retire, they must commit to overfunding their life insurance policy and paying in more premium than is necessary to satisfy the minimum expenses in the policy. Clients who minimally fund their policy and don't put in more money over the costs, they're not going to benefit from the LIBR, as they're not going to be able to accumulate enough cash value. So this is a very important thing to remember, and I'm going to bring it up during the course of this presentation repeatedly. If you want the LIBR benefit, you have to have your client commit to overfunding their life insurance policy. Listed right here are the products for which the LIBR is available on. Notice these are all IUL products. The Flex Life, in this case, it's the Flex Life 2, the Secure Plus Provider, the Life Cycle Solutions, and also not listed on here, but a product that does contain the LIBR benefit is our Peak Life IUL. So there are 3 distinct phases of the LIBR benefits. There's the accumulation period. This is before the benefit is activated. During this phase, it's when our client is funding the life insurance policy, overfunding it, we want to emphasize that, and accumulating cash value. The election phase starts when the client decides to start receiving the LIBR benefits. At this time, They satisfied all the conditions that need to be met in order to exercise the benefit. All that is required is that yourself and the clients make a phone call to National Life Group, fill out a form, and they start receiving the benefits. Lastly, you move into the distribution phase. At this point in time, your client will be receiving that benefit. It's going to be coming to them for the rest of their life, guaranteed. So we're going to examine each of those three stages for the purpose of the LIBR benefit. First, with the accumulation phase. This is before the LIBR is elected. As I'll mention again, I've mentioned already, the policy needs to be fully funded. You need to pay over the minimum expenses. The more you put into it, the better. To help the accumulation grow more quickly, the rider charge is not in effect while the funds are accumulated in the cash value. You can see that before you elect the LIBR, the death benefit is providing protection and the policy is accumulating cash value. Notice when a policy is fully funded, we represent that with that darker color. We represent the policy that's more minimally funded with the blue coloring. The smaller that discrepancy is between the death benefit and the cash value, the larger their payout will be. All right, I see there was a question from the chat. Edmund, yes, copy of this presentation will be sent out at the end. All right, so since we've discussed the accumulation phase, let's move on to the election phase for the LIBR. So listed right here are the conditions that must be met before the LIBR benefit can be received. The clients, their minimum age is 60 years old to receive the benefit, and they cannot receive the benefit after they are 85. There are waiting periods in the policy that must be satisfied before the benefit can start being received. For a Flex Life, Life Cycle Solutions, and Peak Life IUL, the policy must have been enforced for at least 10 years, 15 years for a provider IUL. All policy loans that may have been in existence must be paid off in their entirety before the LIBR benefit can be received. So if you have a client who took out a loan for a down payment on a home or to help their children through college, those must be paid off, principal and interest. The LIBR benefit cannot be received when a policy is owned by a qualified pension or profit sharing plan. The client must meet the maximum death benefit ratio. I'll describe that factor later on in the presentation. Finally, once the LIBR benefit is elected, that's when the charge kicks in. Remember, we save that charge until election time to help out during the accumulation phase. It's great to not have that charge impacting the funds when they are accumulating. Then, once the conditions have been met, the client has some important choices to make that affect the LIBR benefit payouts. Will they reduce the death benefit when it comes time to receive the payouts? And will the payouts be on an increasing or level schedule? Let's take a look into these. Questions I see from the chat. So Sophia's question was, does LIBR have to be turned on at the time of application? Well, Sophia, no, it cannot be turned on until at least 10 years have passed in the policy and the policy owner and the insured is at least 60 years old. The LIBR benefit itself is added at issue. They decide when they want to elect it and start receiving payouts. Brian, does the LIBR come with a 1099 form every year? No, it does not, and I'll describe that later on in this presentation. What is the LIBR interest rate? I'll describe that later on. It's not like the cash value interest rates you'll see for illustrating our IUL. We'll describe that later on. So the first decision I mentioned, an important choice your client has to make before they start receiving the benefit payouts, is whether or not they want to reduce the death benefits prior to electing income. I can tell you guys, reducing the death benefits will create a higher payout. Look at the relationship right here between the death benefit and the cash value. The larger the discrepancy is between the two factors, the lower the payout will be. So if the client is older and their obligations in life have dropped off, the kids are out of the house, the mortgage is paid off, it might be very beneficial for them to reduce the death benefit prior to electing income, as they may not need that much protection and they can reap the benefits of a higher payout. These are conversations you guys should have with them when it comes to be that time to help them maximize their payout if they can afford to sacrifice some death benefit. Second decision they have to make is what type of payout schedule will the benefit be on? The client can elect to have their payouts be on a level basis. This means that they will receive the same amount each and every single year for the rest of their life. However, they also have the option to have their payouts be on an increasing schedule. With an increasing schedule, the payouts start off smaller but grow over time. Notice this graph right on the left-hand side that shows the payouts starting at a lower level than what we see on the level side, but continuing to grow. Eventually, once we hit a threshold where the cash value drops to a certain amount, the payouts will level off. But look, by that time, they're higher than what the client would have gotten if they chose the level option. So clients of yours who start the benefit early and who are betting on longevity, they feel they'll live long enough so that they'll have this opportunity to surpass what they would be receiving via level death benefit. Great option for them to choose the increasing option. Also, it's a great way to ease your clients' anxieties about inflation. With a level payout, since they're receiving the same amount of money each and every single year, they might be fearful that they're reducing buying power. With an increasing death benefit, it increases steadily at a rate of 3%. It's a great way to fight that inflation. Here's the calculation that we use to determine the LIBR payouts. The income base, that's basically the cash surrender value. This is in your client's control, largely. The more money they fund into the policy over and above the minimum expenses, the higher the cash surrender value will grow to be, thus the higher the income base will be. These other factors in here, which equate to the payout percentage, some of it's in your client's control, others are not. The base payout percentage and the adjustment factor, those are actuarial figures. They'll be listed in the contract. Basically, the older the client is, the higher those factors will be, and that'll lead to a better payout. Effectively, those percentages will be higher and more advantageous for the client the older they are. Those are set by the actuarial department. The death benefit ratio, we discussed this earlier. The lower the disparity is between the death benefit and the cash value at the time the LIBR is elected, the better the payout can be, the better that number will be. So that's the equation for calculating the lifetime income benefit rider. The cash surrender value times these factors, which overall equates to the payout percentage. And the base payout percentage, as well as the adjustment factor, those are actuarial figures that will be listed in the data section of the policy contract when it goes over the LIBR figures. Questions? All right, guys, moving on with this presentation. We're going to look at a couple of case studies going over the factors that I just mentioned. Remember how I said it's in your client's interest to at least consider reducing the death benefit when it comes time for them to elect the LIBR payouts. Let's look at this example. Client is 45 years old at issue. They choose a $500,000 level death benefit, and they decide at 65 to turn on the income. The cash value at that point in time is $200,000. With the death benefit ratio formula, we come out with a percentage of 250%. We plug that into the equation. You see the numbers right here The 4.5%, 1.05%, as well as the 350%, those are actuarial figures. Those, again, will be listed in your client's policy if you guys want more of the logistics of that equation. But you see that equates to a payout percentage of 5.55%. To calculate the LIBR benefit, we would take that and multiply it by 200,000, the cash surrender value or the income base. That equates to a payout of 11,000 per year. But this is a client who decided not to reduce that $500,000 death benefit. What happens if they decided to do that instead? Same situation. However, at the time of LIBR election, they decided to reduce it by 100,000, do the max amount reduction possible. Look, that produces an extra $1,200 per year in level payouts. We'll look at these numbers later on as well in the illustration. A question had been posed later on whether or not the client would receive a 1099 when LIBR payouts are being received. Well, a very important benefit that you guys really, I stress this speaking with you guys over the phone, the client needs to understand this as well. These payouts come out of the policy via loans, and loans are tax-free. So the policy owner will not be receiving a 1099. IRC section 7702A says a loan taken from a life insurance policy that is not a modified endowment contract is not counted as income because it's treated as a loan, not as taxable distribution from this life insurance policy. Therefore, as long as your policy is not a modified endowment contract, those benefits will be received for the rest of your life tax-free. I'm going to go over how the LIBR interacts with other riders in an IUL life insurance policy. For those of you that write on NL paperwork, products like the NL Flex Life 2, NL Peak Life, this slide is applicable to those products. For NL policies, first of all, the LIBR benefit is not available on policies where the table rating is above 250%. It's more of an underwriting issue. When the terminal critical illness or critical injury ABR is elected and the client has already started to receive payouts, the LIBR will terminate. They'll get that payout via the ABR. They'll no longer receive LIBR payouts. The same holds true for the chronic ABR. If they elect that after distribution of the LIBR has begun, they can no longer receive that benefit. The LIBR terminates other riders, including the other insured, the accidental death benefit rider, and the disability income rider when the LIBR is exercised. Now, for those of you who write on LSW paperwork, the regular Flex Life 2, non-NL, here how the LIBR plays with riders in those policies. Same thing, it can't be added for policies where they have a table rating above 250%. The LIBR payout, if it's in the distribution phase, is ended when a terminal critical illness or critical injury ABR payout takes place. The big difference right here between LSW and NL is that with an LSW policy, if the chronic ABR benefit is taken at any time, before or after distributions begin, that LIBR benefit will cease to exist on the policy. Also, just like NL policies, the other insured rider, accidental death benefit rider, and disability income rider terminate when the LIBR is exercised. So just important things to remember about how the LIBR affects other facets of an IUL policy for you guys to take note of. So now that we know how the LIBR is calculated and how the benefits take place, here's some key features that everyone should know about. First of all, there's a ratchet feature involved with the LIBR benefit. Every 5 years, we look back at your client's policy values, and if the values have risen, then we'll increase the payouts. It's a very unlikely factor, just because the payouts are reducing the cash value as they come out of the policy. However, if the values have been lowered or stay the same, nothing will happen. The client will still receive the same payout. It's only if the policy values have risen during the 5-year look-back period that will increase the payout. We guarantee your clients that at no point in time will the death benefit be reduced be below 15,000, the cash value will never be reduced below 1,000. It's an important thing to remember. Loans, they're reducing the death benefit and the cash value, but once they hit that threshold, they will not drop any lower. $15,000 death benefit minimum guarantee of $1,000 cash value. The client can stop and then start back up the LIBR payouts. However, that can only take place once per year. And lastly, your client does have the option to take additional loans over what they're receiving from the LIBR payout and or a withdrawal from the policy cash value. However, in order to do this, they would have to stop receiving the benefit payouts. So to go over, once again, the key features of the lifetime income benefit rider, first of all, the guarantees. The guarantees that those payouts will remain in place for the rest of the client's life. The guarantee that they'll always have a death benefit and a cash value, not to drop below a certain minimum. The clients will not be charged for this benefit until the payouts commence. This allows them to accumulate a sufficient cash value that can be used, that'll be more advantageous later on when we calculate the payouts. No additional premium payments will be made into the policy once this benefit is elected. We'll send your client money, they will not send us money. The client has reassurance that if, for whatever reason, the cash value increases due to great market conditions while they're receiving the benefit, we'll impose that ratchet feature and increase their payouts if their policy values increase at a greater rate than what it's being reduced by when the payouts are being received. And also the flexibility that they have, they can stop and start back up those benefit payouts, but only once per year. All right, so we've come to the end of this presentation just over the LIBR benefit in general. Before we move on to the illustration, I'm just going to take some time to answer some questions. I see there's some in the chat feature. So, Richard, how was the $350,000 determined in your calculation? Correction, 350. This example is just pulled from a random case study. 350%. That represents the maximum death benefit ratio. It's an actuarial figure, and this is a calculation that I don't have direct access to. It's a figure that was just put in for the sake of this case study. As I mentioned, though, a lot of these figures, when it comes to the LIBR, the death benefit ratio, and figures like that, those will be described in the policy data pages. It varies client by client. You'll always be able to see those definitions right in the policy itself. But that, Richard, was just an example for the sake of this presentation. Remember, the death benefit ratio, in a nutshell, that's just the relationship between the death benefit and the cash value at the time of election. The smaller that disparity is, the greater the payout will be. Will the client be expected to repay the loan payments? For the LIBR, they are being sent out as loan payments, but no. We send the money to them, they don't pay a dime. If they want to pay back the loan, they can. However, such a benefit is designed so that they never have to pay a dime into the policy. We send them money. We don't want them paying us back. It's a benefit that helps them live their life and relieve that anxiety about outliving our financial resources. But I suppose they could pay back if they wanted to. Other questions from the group before we move on to the illustration? The loan interest rates. For the LIBR, we use a standard loan feature that currently is at 4.3%. I'll explain that a little bit more as we go along in the presentation. All right, as I still leave some time for some additional questions, just be mindful I'm going to switch screens right now. We're going to move over to see an illustration demonstrating the LIBR payouts. Bear with me for 1 minute. Richard asked, can the max ratio result in a lower amount? No, it cannot. The payout percentage will never be negative. Is there a cap in interest? Victor, there is no cap on the loan, but with the LIBR feature, we'll go into that in greater detail, how the LIBR loan interest rate interacts with the interest rate that's credited to the cash value. Lucia, yes. If the death benefit, when the loans are taken out, that does reduce both the death benefit and the cash value via the LIBR. Interest is paid back, Victor, your question, interest is paid back into the policy cash value, not directly to the insured. All right, guys, so I'll just pause briefly with answering those questions to bring you on to an illustration. Remember, I wanted to leave time to show you guys how this would play out, illustrating the lifetime income benefit rider in our system. So bear with me while I pull this up. So for the purpose of this illustration, I have a 30-year-old male, standard non-tobacco. As we know from our illustration software, the majority of our work is done in the death benefit and funding screen. Those of you who aren't aware of the videos that we have available for training purposes, they are available on the agent portal. Strongly recommend those of you who haven't had a chance to watch them, if you're new to illustrating IUL policies, I'd strongly recommend taking some time to review them and see some tricks about how what you can implement into the illustration software for your cases. But for this example, this 30-year-old male, we've minimized the death benefit. We have him paying in $400 per month. Now, let's suppose this individual wants to take the lifetime income benefit rider when they're 60. That's at least their plan right now. They plan on retiring at that age. So at that age, they want to start receiving the benefit from the policy to help supplement their retirement income. So we have them pay premiums until they've attained the age of 59. And then we start showing the LIBR benefit being received at the age of 60. As we know, great feature, the system does all that work for us in solving for the numbers. So you see, as soon as I selected the LIBR benefit from this drop-down menu, we're left with this screen. It's already populated that the benefits will start being received at the age of 60. Now, remember those important choices we have to make. Once it's time to start taking income, it's time to start taking income. First, do they want the payouts to be on a level schedule or an increasing schedule? By default, the payouts are set to a level schedule. So what does that mean? Well, let's take a look at the quick view. You see this individual, if he pays in $400 per month up until age 60, the level benefit payout under the LIBR will be $22,328, and they'll get that for the rest of their life. However, if they choose to do an increasing option, let's see how that will play out. Remember, the level payouts were about $22,000. So initially, that's about a $7,000 difference when he's 60 years old between what he would have gotten with the level payouts. But you see it increases over time till eventually, when he's at the age of 71, that benefit that he's received surpasses that he would have received under a level payout option. It continues to increase. Look at this, all the way until he's in his late 80s. So if this gentleman is betting on longevity, you might want to consider an increasing payout option. I do see some questions coming in via the chat. All right, bear with me for one moment, folks, while I work to resolve this. I understand some of you guys can't see the illustration. Okay, can everybody see it now? Excellent. All right, so for those of you, let's get everybody caught up. I do sincerely apologize for that. I'm not sure why that wasn't showing, but for those of you that didn't hear my example, we're using a 30-year-old male paying $400 per month into the policy and taking the LIBR payout at the age of 31. What I was showing is just the difference between an increasing payout versus a level payout. So we saw with a level payout, it would equate to $22,328. However, an increasing payout, for those of you that didn't get a chance to see it, I might also mention again that the payout option is set to level by default. If you wanted to show increasing, you would just have to select this option. And we see that the benefits start off at about $7,000 lower, but increase over time. And at the age of 71, we've surpassed what we would have gotten for this gentleman if we went with a level payout. And look as they increase over time, helping fight against that inflation, all the way until they level off and reach its peak and when the gentleman's in his late 80s. So great feature to use if the individual is betting on longevity, as it gives them the opportunity to surpass the income that they would have received under the level option. Another feature that'll be in the illustration software when you're illustrating the lifetime income benefit rider is that face amount reduction. Remember, it is advantageous to reduce that face amount if your client is comfortable with it, as it will help them get a higher payout when it comes time for them to elect the benefits. We see how it plays out in the illustration. The system automatically calculates it for you. You see right here, at the age of 59, the death benefit's grown to a little over 500,000, but we drop it by about 50,000 when they start taking income. And you'll notice the discrepancy in the income that they receive if they don't do a face amount reduction. Was at 22,000, drops down, not significantly, but still a little bit of a drop if they decide not to do the max reduction. Someone had inquired about the interest rates involved in the policy. With the LIBR, we use what's called a standard loan, or what I like to call a wash loan. Currently, the loan rate is at 4.3% for standard loans, so that's what we're illustrating at. With this loan feature, the money that's been loaned out to the policy owner, it's accruing interest, that loan at a rate of 4.3%, but it's still used as a basis for cash value accumulation. We still credit interest to that money, even though it's in the policy owner's hands. With the LIBR feature, the loan interest rate is the same as the interest rate that we use to credit money back into the policy on that loaned out amounts. And you'll notice this feature. If I explain this, look at the cash value column. The cash value equates to the premiums plus interest credited. Notice that it continues to grow. It does not decrease. Interest still is credited to the policy even when the benefits are being received. The cash surrender value and the death benefit is what is reduced. But this figure right here with the accumulated value, that represents how money continues to be credited into the policy, even though money has been loaned out to your clients. Just another advantage of using a loan as opposed to a withdrawal in an IUL policy. Ursuline, who decides what the reduced face amounts would be? Ursuline, we will be able to calculate that for you. If yourself or your client calls in at the time that they'd like to utilize the lifetime income benefit rider, we can calculate what the maximum face amount reduction they can do is. And if they'd like to go ahead and perform that face amount reduction, we'll be able to process that before income is elected. Questions about illustrating the LIBR? Okay, so we're going to move on to the second feature that we're discussing in this presentation, and that is how the lifetime income benefit rider is different from taking regular loans against the policy. So, I just saw a question come in from Victor. This is Victor. This is a Flex Life 2 policy, and by default, we've allocated all the money to the S&P strategy at a rate of 6.88%. So, if ever you wanted to compare the benefit received via the lifetime income benefit rider to the payouts that we received if the client were to just start taking loans from the policy, regular loans, I'll show you the discrepancy. So, we'll use the same example with this illustration, but this time we're going to select solve for income. The system will automatically calculate it back to the same figure so that income starts at the age of 60. With solve for income, there's some differences between the LIBR benefit. First of all, this type of payout is not systematic. With the LIBR, the client has to call in and request that the LIBR be activated. He'll have to fill out a form in order to initiate the payouts. Once he does that, he is done. By using the solve for income feature, the assumption is that the client will call in each and every single year and request a loan. It will not be systematic. Another difference with solve for income is that the client has different options when it comes to the type of loan that they elect. Standard loan is the only option on the LIBR, and that's the wash loan option, where the interest rate for the loan is the same as the interest rates that's credited to the policy. However, for those of you who are trying to illustrate the best projections for your clients, you'll find that by using the participating variable loan option. With the participating variable loan option, in this case, the money that's loaned out to the policy owner accrues interest based on the interest crediting strategies that the client is allocated in, like the S&P 500 strategies. Right now, the cap for the S&P 500 strategy is 11.75%. The current loan rate for participating variable loans is at 4.3%. So by using a participating variable loan, when the client starts to taking money out of the policy, they have an advantage. They could potentially have money credited back into their policy at a greater rate than what is deducted for the loan interest. When we show these illustrations, solving for income and assuming that the client will take out loans each and every single year, calling in on their own, the presumption is that the growth in the S&P in the index accounts will be 6.88% per year, whereas the loan interest rate will be 5.88%. They are not identical. The interest rate that is credited back into the policy cash value is a percentage higher. That's what's called positive arbitrage. With those features together, remember the payouts into the LIBR were $22,000. Notice that there's a jump of almost $12,000 when we use participating variable loans. So upside potential. There's percentage that the money in the cash value could grow more quickly than the interest that's deducted for the loan. Some negative aspects though, some things for your client to consider by pursuing a feature like this when it comes time for them to elect the benefit is the fact that it's not systematic. They'll have to call in each and every single year and request a loan for this amount. Secondly, it's not guaranteed that more money will be credited back into the policy at a rate higher than the loan interest rate. So in years where there's no return from the index strategies, there's still going to be money deducted for the loan interest rate. So that might be a little bit harder for your client. They might actually end up having to pay some money back into the policy. As you see also, remember, I was describing the difference between these two columns. The accumulated value always continues to grow. This is premiums plus interest. Interest continues to be paid into the policy even when the money has been loaned out to the policy owner. The growth in this column is much more pronounced than it was in the LIBR payout. The reason being, there's a positive arbitrage of 1%. The money credited into the policy is being credited at 1% higher than what is being debited for the loan interest. Questions, I see? Edward, are they still paying when receiving benefits? No, sir, they are not. With the LIBR payouts, they start receiving those benefits. They never make a premium payment or a loan interest payment into the policy. Money's being paid to them. They're no longer funding their life insurance policy. When they start taking loans out of the policy, the presumption is that if they funded the policy well enough and built up enough cash value, they can take loans out. And if they take loans out for a certain amount, they don't take out more than what is illustrated right here, they could receive this amount each and every single year for the rest of their life. However, it would not be guaranteed. There might be some years where there's no return from the index strategies, and they might have to pay some more money back into the policy to offset what is deducted for loan interest to help the policy stay intact. Can you change participating variable loans to 4.3% annually? You can lower them. Do be mindful that the illustrated rate of return on the cash value can never be a full 1% higher, more than 1% higher than the loan interest rate. Can demonstrate even more of an arbitrage. But yes, you can play around with the loan interest rates to do so. You can adjust it right here. Just be mindful, if you do change it to a low percentage, you'll have to go back in and change it in the interest rates as well to make it so that it's not more than 5% above, more than a full 1% above what the loan interest rate is. Value. This is an advantage about using a loan rather than a withdrawal on an IUL. First and foremost, it's tax-free, assuming the policy is not a MEC. But also, the money, though it's been loaned out, is still used as a basis for interest crediting. It's still a part of the accumulated value. It's not completely removed from the policy. It's the reason why this cash value is growing. Other questions? Edward, we do update these webinar presentations in the schedule consistently. For next month, we do have that posted right on the website as well. And I will be sending out a copy of the slides at the end of this presentation. Other questions you guys have? Remember, for the illustrations, those of you who want more in-depth training on how to illustrate income, other tricks, moving beyond what I just touched on, I would highly recommend all of you visit the Agent web portal and view the illustration training videos. If ever you should need help, you can always contact us here at the sales desk, and we can point you in the right direction to find those training videos. Victor, doesn't if you pay 5.85 loan interest and policy credit, 4.3 to the cash value? Well, Victor, that 4.3 is still interest that's credited back into the cash value. Yes, the loan interest rate is higher, though. Other questions? So Victor, right there, that's in a case where the money being credited back into the policy is at a lower rate. than the loan interest rate. So yet if they chose the participating variable loan, they might see more of a reduction. They have to pay some money back in to help offset the reduction of the cash value and keep the policy in force. Other questions, guys? We still have about 5 minutes. Victor, correct. In that case, it's not exact the math is not exact, but yeah, in that case, for that particular year, a greater percentage of money was debited for the loan interest than was recovered by interest credited back into the cash value. Victor, I'm just not understanding your question. I'm very sorry, Victor. I'm just not understanding your question with percentages. The main thing I want to convey is just with the participating variable loan, there's more upside potential just because you could, if there's a good year in the market, get more money credited back into the cash value than is deducted for the loan interest. But in years when when there's low return, lower than what is actually the loan interest rate, the clients may see more of a loss in their cash value. Nancy, we have yet to see a payout commence under the LIBR benefits. So there's not any solid examples quite yet. The benefit hasn't quite been around long enough for any policies to qualify for the LIBR. Victor, yes, if the S&P rises 6.88% and the cap is above that, then yes, money will be credited at a rate of 6.88%. And in the case of if they're using the participating variable loan, the money that's been loaned out will be credited, that will gain a rise at a rate of 6.88% as well. And the loan rate will be whatever it may be at that particular point in time. We illustrate when we're showing participating variable loans that the S&P will increase, or that the increase in the cash value will be 6.88, and the money debited for the loan, or the interest rate used that is used for the loan, will be 5.88%. So it's a 1% in the client's favor, but we know it's not going to be like that each and every single year. Talia asked, when we receive the LIBR benefit, do we still have living benefits? Well, Talia, with LSW policies, if you sell in that product line, we did discuss this earlier on the presentation, but the benefits, if they are elected when you are receiving the LIBR, terminal, critical injury, and critical illness, those are, if those are elected while the client is receiving the benefit, then the LIBR benefit disappears. And also, if at any time before or after the client starts receiving the LIBR benefit, if they elect to receive the chronic illness payouts, that'll terminate the rider as well, before or after benefits have been received. So good question, Talia. Emily, I do apologize. Right now, we did just move away from that, but right now, just seeing what else you guys have for questions. We have completed the presentation now. Victor, my phone number is 802-229-7289. I can certainly discuss this with you later on. Sophia, thank you very much. All of you guys, thank you very much for attending today's presentation. What I'm going to do is launch the polls that we have just to get some feedback on today's presentation. Just serves as a great tool that we can use later on just to assess this. We do value you guys' feedback. And again, guys, the slides for this presentation will be sent out following today's presentation. I'll also send out a survey just looking for some additional feedback on today's presentation. We do highly value you guys' opinion and feedback on these presentations. It's just a great insight as to how we can improve later on in the future. Anybody else have any questions? Victor, you can certainly reach out to me. I can also reach out to you later on to discuss the example that you're going over. Victor, my phone number again, 802-229-7289. All right, guys, any additional questions before we wrap things up for today? All right, well, thank you all. Thank you guys, all of you for attending today's presentation. Certainly did enjoy having a chance to work with you guys and explain these benefits. If you have any further questions, my name is James. I'm a member of our sales desk here at National Life Group. I'm more than happy to assist you guys. If you have any questions, you're more than welcome to contact us here at the sales desk. Otherwise, have a wonderful rest of the day, and just be advised that we'll also be sending out these slides for today's presentation. Victor, I'll look forward to speaking with you soon. Everyone else, have a wonderful rest of the day, and we'll look forward to hearing from you soon in the near future. Take care. Bye-bye.